Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Christine Benz shares some investment ideas for your IRA. Damian Conover takes a look at valuation within the healthcare sector through an ESG lens. Dan Satiroff discusses why international stocks have lagged behind the U.S. market. Connor Young highlights 11 up-and-coming under-the-radar managers. And Christopher Inton unpacks why opportunities in gold are limited. Let's get started. First, Christine Benz shares some investment ideas for your IRA.
Hi, I'm Susan Jabinski from Morningstar.com. Many investors are beginning to gather their documentation for the April 15th tax filing deadline, and that's also the deadline to make contribution to an IRA for the 2019 tax year. Joining me to share some fund ideas for an IRA contribution is Christine Benz. She's Director of Personal Finance for Morningstar. Christine, thank you for joining me today.
Susan, it's great to be here.
Now, let's start with a general question. If you're making a contribution to an IRA, how should you decide how to invest those dollars?
I think a good starting point for that is to take a look at where your portfolio sits today in terms of its asset allocation, how you are positioned across the Morningstar style box, and of course our X-ray tool is a great way to get a read on all of that. So take a look at how you are doing relative to your target allocations and use your new IRA contributions to help correct any imbalances or any changes that you'd want to make in your portfolio. The good news about an IRA is that you can make those changes without incurring tax consequences, but I feel like you might as well get the IRA contributions in on the action as well.
Now, one place that a lot of investors may be underrepresented would be the small value portion of the U.S. style box. Do you have any ideas for us there?
Yeah, we have seen this dramatic bifurcation. Small value stocks have performed well, certainly in absolute terms, but over the past year, I looked, Susan, large growth stocks have doubled the return of small value. So if you haven't looked at the small value space recently, it might be time to give it a look. And a fund I would call out here is Diamond Hill Small Cap. It has a relatively new co-manager in Chris Welch, but he has been running Diamond Hill Small Mid Cap for a while now and has had great results there. The small cap fund is silver rated. It uses a focus on competitively advantaged firms. It looks to buy them when they're trading at a discount to what the management team thinks they're worth. So our analyst team thinks it's a really sensible strategy, a lot lining up in favor of this small cap value fund. Of course, you could also use an index fund for small cap value exposure as well.
Now, another area where investors might want to top up a little bit is international stocks.
Right. We've been banging this drum for a while. And really, here's another area where if you look over the past decade, the MSCI EFA index has returned just half of what the U.S. market has returned. So a substantial level of underperformance. When that will revert, whether that will revert, I guess is anyone's guess. But I think it's probably something that investors should take a look at, potentially doing some repositioning with respect to their foreign stock holdings, adding a little bit of oomph behind their foreign stock holdings, adding more money to foreign stocks. So a fund I would mention here is a contrarian leaning fund, high conviction fund for sure, Oakmark International. It's one that we've liked a lot for many years. David Hero has been in the seat here as lead manager since 1992, so even longer than I've been here at Morningstar. Very seasoned manager. He has been bringing up a co-manager. Michael Manelli has been working alongside him. This is a fund that does require some patience because it will have periods where it will look pretty bad relative to its peer groups. But it truly, in my view, defines active management. That if you're going to pay for active management, you want someone who is really running a high conviction portfolio as this fund has been. So this one is gold rated.
And then your last pick is a core bond fund. And how should investors be thinking about adding bonds to their portfolio?
Well, the way I look at it is we've had this long-running rally in the equity market overall, more than 10 years today. And meanwhile, we're all 10 years older than we were when this began. So for investors who are getting close to retirement, who haven't looked at their portfolio's asset allocations for a while, if they've been hands-off, which is how you should be, you might want to think about adding a little more to the safe portion of your portfolio. And so a fund that I would mention, this is kind of the linchpin holding in my ETF portfolios, is iShares Core Total USD bond market, and the ticker is IUSB. And so it's a lot like Bloomberg Barclays aggregate tracker, but it has a little bit of a kicker in that it holds some low quality bonds, not a lot, sub 10% position currently, but nonetheless a position in lower quality bonds. So I think it actually makes it a little more inclusive and diversified than the total market trackers. So it's a gold rated ETF, and I think it's just a nice choice for kind of one-stop fixed income exposure. We've got it in the Core Plus intermediate term bond category. It will have a little bit more volatility, especially in periods of economic weakness, than a Bloomberg Barclays aggregate tracker, but I still think it's a good kind of hands-off, low-maintenance one-stop choice for fixed income exposure.
Sounds great. Well, April 15th will be here before we know it. So thank you very much for these fresh ideas, Christine.
Thank you, Susan.
I'm Susan Jabinski from Morningstar.com. Thanks for tuning in.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa.
Now, Damian Conover takes a look at valuation within the healthcare sector through an ESG lens.
Bringing an ESG lens to valuation work we do in large cap pharmaceutical stocks is really important. And one of the areas within ESG that we like to focus on when looking at this particular group of stocks is side effect risk around drug development. So really the S in ESG. And what we found is two really important takeaways. First off is in ESG, we can see that in certain cases, drug development will cause side effects that are really unknown to the prescribing community. However, in certain cases where you're developing drugs for very severe diseases, the side effects are less important. And one company that we think looks very well positioned in this context is Roche. They're developing drugs in oncology and other areas that are very severe. So if side effects come up, it's probably not going to be overly problematic. On top of that, we think Roche does look undervalued. One of the other important thematic elements that we see with ESG is looking at litigation concerns. Sometimes when litigations come up, the investment community overly penalizes the firm. Bayer is a good example of this. Bayer currently is going through a lot of litigation around glyphosate. We think the risks are overdone, and we think the stock looks undervalued. Overall, ESG really does help us bring a better valuation lens to our outlook within the healthcare sector.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Dan Satiroff discusses why international stocks have lagged behind the U.S. market.
Hi, I'm Christine Benz from Morningstar. As U.S. investors well know, foreign stocks and foreign stock funds have underperformed U.S. for the better part of a decade. Joining me to discuss the factors driving that underperformance is Dan Satiroff. He's an analyst in Morningstar's Manager Research Group. Dan, thank you so much for being here.
Hi, Christine. Thanks for having me.
So, Dan, let's just look at the level of underperformance of foreign stocks relative to U.S. How big has it been?
So it's been pretty big. I think most people at this point are kind of aware that, that dichotomy that exists between the U.S. and foreign markets. So to just put some numbers on it to set the table here, the U.S. market, if we're looking at March 2009, so the bottom of the financial crisis, right, up through last month, December 2019, the U.S. market, as measured by the S&P 500, returned about 17.1% annualized. Huge number, right? Right? So sort of the comparable index overseas is the MSCI All-Country World Index, ex-USA. So what that has done is about 9.9 percentage points per year. So you're seeing around a 7% annualized return difference between those two indexes. So it's pretty large and understandably so. It's what a lot of people have noticed.
Right, definitely in our portfolios we've seen it too. So let's go factor by factor, and one that kind of jumped out at me, and you and I were exchanging emails about this, currencies. Is it the fact that the dollar has outperformed relative to foreign currencies? Is that part of the issue?
So it is a component there, right? So what we've seen over most of this period, this 10 plus years that we're talking, is the dollar has appreciated relative to a lot of foreign currencies, the euro, yen, pound, you name it. So that obviously creates a drag on your foreign stock returns when you go to repatriate your assets from overseas back to the U.S. the exchange rate is going to be less favorable in the future than it was when you made those investments. So it drags on it. It's part of it, but of that 7% delta that we were talking about, the currency effect has only been about half a percentage point. So you still have another 6.5 percentage points to go to explain the gap there. So it's part of it. It's just a relatively smaller. Yeah.
Okay. So another factor that I think might be reasonable to think about would be the sector composition of the U.S. market versus the non-U.S. indexes. And so let's talk about that. The U.S. tech stocks have been rocking the house.
Right. You got the FANG stocks and everything.
Right.
They've been really providing some tremendous returns. Been driving a lot of the U.S. stock market appreciation over the past decade or so, and it seems pretty reasonable. When you go overseas, back in March 2009, the starting point I referenced, foreign stocks were really kind of dominated by financials, and then you also had some materials and industrials. It was a very different market composition over there. So it seems reasonable to suspect that market composition played a role in it. So we kind of tested that, and we ran it through Morningstar's attribution tool. And what we found was that sector composition was actually a very, very small component of that return difference. Most of it really came down to like what you would call just other factors. It was U.S. companies just really broadly outperformed their foreign counterparts pretty much across the board in every sector. So there was a component there, but it was, again, it was very, very small, even smaller than the currency effect that we were seeing.
Okay. So you're saying that it really owes to fundamental factors, and you're saying that U.S. companies have performed better, or has
Correct.
it been PE expansion?
It's other things going on, and you could probably frame this in a lot of ways. One way we framed it when we were starting to dig into this is kind of like you're saying, there's other fundamental drivers, right? These are actual businesses at the end of the day, and they have to earn a profit at the end of the day. So what we did is we took the total returns from those two indexes, and then decomposed them based on the PE multiples. So we basically came up with two components that if you add them together, you get the total return. So that is the multiple expansion, which is how has price grown relative to the earnings generated by that index. And then you have EPS growth, which is sort of like basically how have you grown your profits over time, right? So when you add those two together, you get total return. So if we break those two things down, what we see is that U.S. stocks and foreign stocks performed very comparably in terms of multiple expansion. They both expanded their price relative to earnings at about 6 to 6.5% per year, which was kind of interesting. But then when you got to the EPS growth, that is where U.S. companies just blew away foreign stocks, and it wasn't even close. Foreign stocks grew their EPS earnings per share by about 4% per year. The number for U.S. stocks was a little over 10%, I think around 10.3, 10.4%. So that's where you see that extra 6.5% gap that I was referencing before. It was really, at the end of the day, U.S. companies were just growing their earnings and their fundamentals much more stronger than the overseas companies were.
Okay, so that really underpins that narrative that we hear so often, is that the U.S. emerged from the financial crisis stronger than most non-U.S. economies.
Yeah, for sure. I mean, you could point to all sorts of reasons. I'm not going to get into it now. Some of them maybe have more validity to them. Some of them are more speculative. But yeah, for sure, the U.S. has been incredibly strong. It continues to be very strong. To put a kind of a bow on this, though, I think, it's really, you have to come away from this with like, well, what does this mean for the future? Sort of thing, right? So when you look at your portfolio now, it's like this in mine because I'm diversified internationally as well. U.S. stocks are kind of the lion's share right now, and my foreign allocation has been dwindling just because of the appreciation of U.S. stocks, right? So, this doesn't exist. This isn't going to continue indefinitely. At a certain point, things are going to, turn around. I think if you go back to the mid-2000s, you saw, a pretty long period where we came out of the dot-com bust, and foreign stocks took off. So this isn't going to last. These things move in cycles. Currencies move in cycles. Foreign markets move in cycles. You have to rebalance. You have to get rid of some of your U.S. stocks and buy foreign stocks and be ready for when it turns around. And we were talking before, we've been saying this for the better part of 10 years now. It's getting a little annoying, but yeah, the prudent advice, I think, is rebalance and shore up your allocations back to whatever your portfolio targets are. So.
Okay, Dan, terrific research, really interesting to me. Thank you so much for being here.
Oh, thank you.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Next, Connor Young highlights 11 up-and-coming under-the-radar managers.
We recently added 11 strategies to Morningstar Prospects, a list of up-and-coming or under-the-radar managers. The additions include 4 strategies with environmental, social, and governance, or ESG approaches. Calvert Equity and Brown Advisory Sustainable Growth effectively combine ESG mandates with large growth investment styles. iShares ESG, U.S. Aggregate Bond ETF, and TIAA CREF Green Bond are among a growing number of fixed income ESG offerings. The iShares product provides a low-cost passive option, while TIAA CREF Green Bond is unique for its focus on investments that have a direct ESG impact rather than simply screening on ESG criteria or considering those factors during the usual investment process. The prospects list includes other compelling strategies: Alger Midcap Focus, Cheer Capital Allocation, Brown Advisory Midcap Growth, Allianz GI Performance Fee Structured U.S. Equity, and Allianz GI Performance Fee Structured U.S. Fixed Income are all relatively new offerings from proven managers. Amy Zhang, manager for Alger Midcap Focus, has steered Alger Small Cap Focus to an excellent record since 2015 and previously contributed to solid results at gold-rated Brown Capital Management Small Company. Ryan Caldwell, lead manager for Tier Capital Allocation, had success at Waddell & Reed before he brought that approach here in 2015. George Sakalaris and Christopher Barrier applied the same process at Brown Advisory Midcap Growth that they've honed at Brown Advisory Small Cap Growth since 2006 and at a Midcap Growth separate account since 2012. Last, Greg Tornan's options-based strategy at Allianz GI Performance Fee Structured U.S. Equity and Fixed Income Funds is similar to what he's used at bronze-rated Allianz GI Structured Return. The remaining 2 Prospects additions, MFS Midcap Value and Musenich Credit Opportunities, are a bit more established than most on the list, with solid medium or long-term records from talented and well-resourced teams. Again, our Prospects list is intended to draw attention to promising funds that we don't yet cover. The 11 strategies I've just mentioned are the newest additions to the list. We'll update this list again this summer.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Christopher Inton unpacks why there's limited opportunities in investing in gold right now.
2019 saw the resurgence of gold investment demand, leading prices to spike nearly 20% to more than $1,500 per ounce. Unlike previous rallies that we argued were fleeting, today's environment is different. With the Federal Open Market Committee cutting the federal funds rate 3 times since August 2019, the investment case has strengthened. Amid heightened investment demand, we forecast a gold price of $1,500 per ounce for 2020. However, when it comes to gold as an investment, today's demand is tomorrow's supply. Investment-driven buyers can quickly sell when real interest rates rise. In fact, ETF-held gold has reached record levels and now sits equivalent to roughly a year's worth of mine production. We forecast investment demand will eventually begin to unwind, which would weigh significantly on prices. Worse still, the vacuum left by declining investment demand is likely to remain unfilled. Although jewelry is the largest source of demand, a combination of government initiatives and shifting preferences should drive slower growth in China and India, the 2 largest markets. The demand vacuum unfilled, we forecast a real price of $1,250 per ounce by 2022. With gold prices roughly 25% higher than our long-term forecast, we see limited investment opportunities. Although individual miners have the potential to create value through cost reductions or production expansion, our forecast for declining gold prices outshines any operational upside, limiting any investment attractiveness.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.